Hello students, welcome to the session. So in our previous introduction to accounting, we have learned some of the qualitative characters of accounting. We know what is accounting now, and some basic understanding of how it works, how it functions in an organization, what is the purpose and use of it, what is the position of accounting in any organization. We know there are some qualities for accounting: relevance, reliability, understandability, and comparability. So relevance and reliability means that the accounting information should be relevant to the reader. It shall not be vague, and it should be accurate, and it should provide the data that the user is looking for. Reliability is supposed to mean that the information has to be accurate and it is true and faithful to the required extent. So comparability refers to that the accounting information has to be prepared in a way that it should be able to be compared with other accounting data, other accounting information from a previous period of the same organization, or from the previous period of a different organization, or of any period of any organization. Therefore, what we use is we have a set of rules on how to prepare accounting books, such as the sales books, ledgers, balance sheets, profit and loss accounts, so on and so forth. So we have a set of rules. If we go by those rules, we will be able to create accounting books that makes the same sense as the other accounting books made by other companies. Therefore, we will learn those rules in the future. So now we have been seeing the objectives of accounting. The main objective is maintenance of record of business transactions. We know that accounting is simply concerned with recording of business transactions in an orderly manner and in a way that it will be helpful for the readers of such information, whether they be belonging to the company or outsiders such as stakeholders. So these financial transactions are monetary terms purely. So they have been recorded continuously to make sure that when in the future we require the data, we can acquire it from our books whenever needed. Calculation of profit and loss is probably the second important objective of why we have to have accounting in our organization. So if the business continues performing, if it is a small business, let's say whose turnover is about 1 lakh or 2 lakh maximum, or even up to 3 lakhs, the owners of the business, the promoter of the business will be able to identify whether he is incurring profit or loss for that period from the cash that is remaining in his hand. So even if you are borrowing, like let's say if you have a capital of 2 lakhs and you're borrowing some money from some lenders, about 50,000, and you use that money to buy products, and then after selling the products you have about 3 lakhs in your hand, you clearly know that it is 50,000 rupees profit. I mean, that doesn't take much analytical knowledge, but businesses in large scale are performing huge operations. They are about anywhere between crores to 100 crores or 1000 crores or even 1 lakh crores. Therefore, the billion-dollar businesses, even the small businesses that's running in crores, we do not keep track of what is the exact outgoing, or we cannot remember the total expenses paid, income earned, or the revenues earned, and capitals borrowed, so on and so forth. Therefore, it is much more necessary to keep track of all that accounting information, so we can consolidate such information and come to a conclusion at the year end, or whenever we want, to make sure if we are earning profit and how much the profit accurately is. So what we need is such accounting information to do the calculations. So first step is we record the information. Second step is we do the calculation to figure out whether the company has been incurring profits or losses. Third one is depiction of financial position. Like I said before, there are some borrowings made by the company. There is always some kind of borrowings made by any company. That such borrowings become liabilities. Therefore, the promoter is in a position that he is liable to return such kind of money, to make good of such kind of money that he has borrowed from the people who he has borrowed from. So if he has borrowed from a bank, then the promoter is liable, or he is responsible for paying repayment of such money to the bank in due time. So that is called a liability. Whereas at the year end, after the sales, if he has 3 lakhs, which is 50,000 more than the initial amount he had, then it means he earned profit. So if he uses that profit to buy a motorcycle or something, let's say he buys a motorcycle for 50,000, and then he uses that motorcycle for doing sales from the next year on, then he will invest the remaining 2,50,000 in the business, and then maybe he will be able to earn the 3 lakhs again. So in that case, before the first year, he had no kind of intangible asset or anything. He does not have any resources to help him. But at the end of the first year, he had a profit of 3 lakhs, but from the 3 lakhs, he bought a vehicle of 50,000. So that is a resource. He can use that resource to increase his sales, increase his performance. Therefore, that resource is called an asset. So what the accounting tells us is that a proper record of resources owned by a business organization is an asset. Therefore, any resource whatsoever, whether it is tangible or not tangible, whether it costs something or doesn't even, it is free, it was acquired for free. If it is a resource that is being used by the business organization, and if there is a record of acquiring that resource, then it is called an asset. Similarly, if there are any claims against such resources or such company itself, such company itself, it is called a liability. So these asset and liability, how much of an asset a person has and how much of a liability a person has. For example, in our case, that promoter who had 2 lakhs at the beginning borrowed 50,000 from a bank, and then he earned 50,000 as a profit. So he used that 50,000 profit to buy a motorcycle. Therefore, he now has a liability of 50,000 and an asset of 50,000. So it is net zero. So we use the calculation of how much assets there is in a business and how much liabilities there is in a business, and consolidating all that information into one statement is called balance sheet. The balance sheet is the position, a financial position of any company. So if the balance sheet shows that there is too much liability, it means that the position of the business is too bad. If it shows that there are a lot of resources in the company which can be used for earning more revenue, then the financial position of the company is really good, and a good investor would like to invest in that business. Therefore, balance sheet is called the position statement, and it is much important for any organization. Accounting information, we know now accounting information, and we also have seen all of these points. This is another objective of accounting. One of the objectives of accounting is providing calculation of profit and loss and knowing the financial position, and the next objective is to disseminate the accounting information to the necessary users. So we know the two types of users, internal and external users. Internal users refer to the management people, the top management, chairman, owners of the business, employees, whatever the shareholder there is, they are all the internal users, and the external users refer to whoever who is not part of the business, but still interested in the position of the business. So first one, investors and potential investors are they know the information. Investors are someone who has already invested in your firm. Potential investors are someone who would like to invest in the firm. So but before they invest, they need to know whether the business is performing well, whether it has performed well in the previous year, and does it show promising improvement in the upcoming year. Only then the potential investors will invest in the firm. We have already seen how much an investment helps in a business, for a business to improve its profit and revenue. Therefore any company would want to increase its investor base, thereby increasing the power of the company by having more money, working capital and everything. Therefore investors were one such users of information. Unions and employee groups are part of the company. They need to know that they are working in a standard or a stable organization, and it will not they will not lose their jobs in the near future, or they will not be let go without being paid their salaries in the near future. So that's why they need it. Lenders and financial institutions simply refers to the banks and other organizations that has lent money for the businesses. They also need to know if the business will continue running. Suppliers and creditors are also another kind of lenders. They are called lenders because they have given their products for free, and they didn't give for free. They are giving it without taking any money for the time being, but for the future point they will need their money back. So they need to know that the business will still be stable in the future. So that's why they use it for. Customers obviously know, because they want to know if there is a continued supply of the products and their services by the business. Government needs to know, because they, like I said before, as in the RBI, SEBI, Companies Act and everything, the regulations and rules have been followed properly. Social responsibility groups such as environmental groups need to know, because they need to know the impact that the business creates on the environment. They are caring about the protection of the environment, so they need to know what are all the impacts that the business creates in an environment. So competitors' information on the relative strength and the weakness of the competition, and the competitors are not exactly the desired users of information, but even then they will use the information, because they need to know how they will compare their balance sheet with our balance sheet to make sure which one is performing well, and which is a bigger business, so on and so forth, which has the more likely to survive in the future, and which will dominate the market, and so on and so forth.